Welcome to Cherry Street Investor Education with Kavitha Baratakke, passive income coach and founder of Cherry Street Investments. Education that is designed for you to take control of your financial life. Join us to learn how you can create multiple passive income streams, diversify your portfolio, save on your taxes, and much more. Become a better investor and fast track your financial goals. Here's your host, Kavitha Baratakke.
Hey guys, this is Kavitha Baratakke from Cherry Street Investments. I'm excited to join you guys today to talk a little bit about what's going on in the market. Obviously, you guys are hearing sensational news of doom and gloom everywhere. And how much of that should you worry about in terms of existing investments, and also what kind of opportunities or what kind of actions you can take for future investments in the next year or so. So I want to touch upon 5 things today. One is, let's talk a little bit about interest rate increases and all the related drama around it, like what we're going through right now. The second thing I want to talk about is its impact on real estate. Obviously, there is some impact. I have a list made out here, so I just want to briefly look at the list. And the third is, what are the opportunities we expect will come up in the next year because of what we are going through in the market right now? And also what personally my plans are for the rest of the year and the rest of the 6 months really from now on. And last but not least, I also want to talk about the overall sentiment of all the investors. And I'm talking about people like me who are investing in the market and doing these syndications. And for folks like you who are looking at the market and wondering what is really going on. So anyway, I'll touch upon this at some points throughout this little talk, if you will. And I would love to hear your feedback, and we'll go from there. So let's talk about the interest rate hikes. You've seen what's happening in the market as the Fed increases the interest rates in an effort to control inflation. We are seeing obviously an aftermath of that in rising mortgage interest rates, rising commercial agency debt, as well as bridge loans, and across the board, every kind of debt there is, right? Car loans and everything else. So the Federal Reserve controls what we call the Fed funds rate, which determines a lot of other rates in the market. Not directly proportional, but they kind of follow that Fed funds rate to some extent. Now, what's happening right now is the consumer price index, which tracks the inflation. I think it kind of omits certain very important pieces like gas in CPI, but let's just take the CPI. We saw an all-time high in the CPI, I believe, of I had written down somewhere 9.1 in June of 2022, 9.1%. That's what the inflation or the consumer price index was, which was a 40-year high for us, right? So obviously that came as an effect, that came about because we had printed about $5 trillion during the pandemic. So the government overprinted money, and now we are trying to remove all this money from circulation, right? So as we started increasing interest rates, we are seeing inflation pulling back a little bit. So we saw September about 8.2%. The October CPI numbers are not out yet. They're expected to be out November 10th. Before it comes out, we're anticipating around 7.9. And so we saw a 75 basis points increase last month in September and October, another 75 basis points. We are seeing another 75 basis points in November right now, right? So we just saw. So we're expecting another 50 basis points increase in December based on CPI data for October and November, right? So essentially what they want to see is that slowing down of CPI or reducing CPI. And also we have been in 2 quarters of negative GDP has happened already. So we were in recession, but we didn't see a pullback in the data for job growth, right? So obviously that's happening across the board right now. You guys are hearing about a lot of job pullback. Now we got to see what the job data shakes out to still. Overall, are we adding jobs? What percentage are we at? I think we were at around 5.5% job growth And so I think as of July, August, somewhere there. And so we are probably going to see a declining number there, which is what we want to see to push us into that negative, hopefully a declining inflation. So anyway, a lot of numbers there, but what are we taking away here? Obviously, to go buy a house, it's very expensive to buy a house. And I was reading somewhere that you could buy a $600,000 house at 2 or 2 to 3% interest rate, somewhere 2.5 to somewhere 3.5. About a year ago, and now you can buy a house worth 320K for the same price. So that's the effect of obviously increasing interest rates. So that has dampened the housing market for sure, and there's more inventory on the market, but there are also people are not listing the houses because they do have equity in their homes. Prices haven't plunged. This is not another 2008 happening here. So prices haven't plunged. So we are still seeing some decline in, obviously, as if you're forced to sell, you have to price below, right? You have to drop down the pricing right now. So there aren't too many sellers coming on the market right now. So inventory is low, sale activity is low, because you could go get your term sheet today and get a certain interest rate. 30 days when you're closing, it might not be the same anymore. So that's the danger of closing in today's market. And let's come to real estate investors and the impact on it, right? Precisely the reasons we had issues with both our closings, last 2 closings we did on apartments, is that the interest rates went up from when we got the term sheet and did our underwriting to when we closed, and significantly so. So especially if you're doing some kind of bridge loan, interest terms can vary very rapidly as the market's changing. But if you're doing an assumption, for example, you might be better protected. But then, obviously the principle on the assumption is not going to be the same principle as you're buying the property, assuming the seller is making some profit there. So you have some intermediate debt to place, or some other kind of mezzanine debt, as we call it. Anyway, that pushes the interest rates up a little bit as well for you, even though you're assuming, unless you're doing a really low leverage on the assumption and raising a bunch of money. So all this uncertainty has pushed a lot of real estate investors to sit on the sidelines and wait until the market or the debt market stabilizes, because we just can't afford to go into an investment not knowing how we'll close, or if we'll close with the same terms that we started with, right? So that pushes a lot of uncertainty. And so I think personally, and with everything I'm hearing and talking and listening, so I just went to a conference in LA for an investment summit, and talked to a lot of experienced investors who've seen various market cycles. And we're all in agreement that interest rates cannot go up indefinitely like this, because we have a huge debt, a national debt. And I was reading these numbers. This is astounding, you guys. We have a $31 trillion debt. The way you can think about debt is every person in this country, if I were to do a per capita debt, or a debt per person, is about $93,000 per person in America today. So that's the national debt we have. Now, as the Fed funds rate inches up, so does the interest on our national debt. So we are paying $965 million in interest every day on the national debt. And this national debt is taken by the US Department of Treasury, and they owe others for this debt. Now, who do they owe? Let's talk about who they owe. Some debts are one government agency loaning to another. That's okay. Some debts are held by the public. So of the public debt that's held, almost $7.7 trillion are held by foreign governments and banks. The rest is held by public, you and me, investors, private investors like you and me. And it's held in terms of treasury securities, bills, and bonds. Now, the good silver lining here is about 40% of the debt is held by actually the Federal Reserve, is owned by the Federal Reserve. So what happens is Treasury pays them and they pay the Treasury back. So there's a little kickback there. So we don't have to worry about that portion, but still, as the debts interest rates increase, so do the debt payments increase. So I do believe that we just, with this kind of whopping debt, we can't afford to increase the interest rates crazy, right? So that's sort of the logic there as how much Fed can push the rates. Now, how they will control inflation, it's kind of like this trickle. I mean, it's going to take some time to actually see the effects of what's happening right now. It's not going to be obvious in a month, right? I think it's going to take some time to slow down. And we are seeing that in the market. The stocks are coming down. It's all red all over the place. Meta's laying off, Salesforce is laying off. Of course, Twitter laid off a bunch of people for other reasons. But overall, I feel like we are definitely seeing the effects on the market, right? We all agree on that. So now let's get on to buying opportunities, right? So I do believe that every pullback is a new opportunity for us to start over. And for those of you who thought and sat on the sidelines in 2008 and said, I just wish I had, it is time for you to guys to get your money together and be ready for opportunities that will come up in the next year. So this is what overall we believe in, right? We believe that the Fed will continue to push interest rates until they feel like it's somewhat in control. But at some point, they got to start pulling back. And we do think that by 2023, mid 2023 to late 2023, we'll start seeing a pullback. And at least we'll start seeing some certainty on which direction the ship is moving, right? How long are we going to increase interest rate? When are we going to start pulling back? We'll have some clarity, maybe first quarter, second quarter of 2023. And by the last quarter of 2023, we are hoping that there'll be some pullback in the interest rates. Is it going to be 2 to 3%? We saw again, no, we are just spoiled there, right? So we could come down marginally, but we'll still start seeing hopefully a interest rate decrease over 2023 and 2024 is what most of us are anticipating. So let's say I can buy an asset at a great price right now or 2 quarters down the lane from now, and I'm able to get seller financing or place some kind of debt, like a bank debt, which is still a good rate. I think we'll go ahead and do that, right? If the numbers make sense, why not? And then we can always refi into better loans as the interest rates pull back. That's how I think of it as an investor. The key, though, is that you should have enough cash flow or reserves to support that property while we go through this uncertainty. And that's sort of our logic on all our properties. We are unfortunately stopping distributions on some properties with bridge loans. As some of the investors are aware, they probably have seen this fallout, because we need to start preserving cash so we can use it for our bridge loan payments. For those on fixed loans, we are gold. We are fine. We are distributing as usual, right? So we have to take the measures we need to tide over, because capital preservation comes first when we hit a storm like this one. But at the end of the day, we're looking at long-term goals of investing in real estate. It's never the short-term gain. Cash flow is just icing on the cake, right? So we want to have enough cash flow and cash reserves to tide over this moment in time. But overall, our goal is to get to increase valuations for the property and appreciation and more, right? And we buy it in strong locations, so those are not issues. And also understand that when recession happens, more renters come to the market, right? Because people are uncertain, interest rates are high, they can't afford to buy. So what's going to happen is that more people are going to want to rent. So from a multifamily perspective, we're not really in a bad position from a renting standpoint, because more renters are in the market than buyers. So we are well occupied in our properties, and we're positioned to tide over whatever comes ahead, which is why we call it a recession-resistant asset. So anyway, there'll be some buying opportunities next year. I hope you guys are all prepared for it. Stock up your reserves and save up your money and get ready for opportunities. I am particularly working on some cash flow opportunities. So there are two ways to kind of handle this uncertainty, right? One is if you're making, let's say, a 5% or a 10%, you have a 5%, 8% margin, it's really hard to just make the debt payment right now if you place debt, right? It's really hard to cash flow anything and pay investors anything if I'm going to buy a 6 cap asset and pay 8% in debt. It just, the numbers don't work out. So, but let's say I buy I have a ATM machine or have a car wash that is producing 30-40% profit margins. I can still place debt if I need to at 7-8% or get bank loans or bank debt at a little lower percentage and continue my business as it is, right? So I do think there are opportunities in every market. It just depends on what you're looking for and what you're comfortable investing into. So I think what I prefer at this point is high margin, large margin investments like ATM machines. They also throw off a lot of depreciation, like 100% depreciation, which is not recaptured because these machines lose value after 7 years. Also looking at car washes, I was just shocked at the valuations they trade for if it's a subscription model. And then also looking at the cash flow in those, they throw off a lot of cash. So those are kind of assets that I'm looking at in a down market. I'd love to learn what you guys are investing into in a down market, and let's have a discussion. I hope this was useful. Do get in touch with me if you're interested in investing or just to have a complimentary discussion with me. I'm also putting some money in my insurance policies right now and stocking some money up there. So it's growing at a good pace where I can borrow from it when I see opportunities come by. So talk to me about infinite banking, talk to me about ATM investments, talk to me about other investments on the horizon that I have. We are still doing land development. Everything's going on as we intended there. Nothing's off right now. So we are doing a lot of projects and we have them in the pipeline already. And I'd love to discuss with you on how I can help you invest through this uncertainty. And last but not least, do look at I-bonds and 2-year bonds. If you haven't looked at any of those investments, they do offer great rates. And that might protect at least some of your money. You can't put a whole lot into those, but some of your money from being eroded by inflation. Happy investing. Thank you for listening. Hi, I'm Kavitha Baratakke. I hope you found this video useful. And if you did, please don't forget to subscribe to my channel so you can get notified of any future videos I upload. I plan to cover a lot of investor education on this channel, and I hope you'll stay with me for it. If you have any feedback on future content you'd like to see me cover, please drop me a note or a comment on my video. Thank you for watching and thank you for supporting me.